I'm Lisa Durant from Lion's Eye Wealth. I'm the president of the company, and I want to welcome you all to the fifth episode of the podcast and the very first video that we are recording, which is very exciting for Lion's Eye Wealth. Today, I'm super excited to have a guest, Alan Strauss from Crystal Capital Investments, and we're going to be discussing alternative investments. But before I introduce Alan, I just want to remind everybody that the opinions that I express today, as well as Alan, are our unique opinions, and it's not meant to be specific investment advice. It's meant for you as information and education to inform your decision making and maybe be curious about alternative investments. So first, with that, I want to introduce Alan from Crystal Capital Investments. We're so excited to have him. They're an amazing team down in Florida, and I'm so excited that he's going to kick off the video series for us. So Alan, if you could introduce yourself and tell us a little bit about your work, that'd be great.
Absolutely. Thank you, Lisa. Thank you so much for having me. It's really a pleasure to join you on the podcast here, but most importantly, it's really a pleasure to work with you and your team, and obviously through time clients at Lion's Eye Wealth with their alternative investment needs and objectives. As you said, my name is Alan Strauss. I am a senior partner and director of investor relations here at Crystal Capital Partners. And what that means is I've been here for about 13 years now, coincides with my favorite number of my favorite, greatest quarterback in NFL history, Dan Marino, but we'll leave that for another time. We're based here in South Florida. We've been here for over 25 years, investing in the hedge fund space. And what I get to do is really focus on client engagement. Our clients are registered independent advisors and supporting those advisors with accessing certain investment opportunities, helping them understand how those would fit within portfolios, providing educational content so that advisors can really understand and put those things into context for their clients. Obviously helping to onboard new advisors as they become clients of ours, and supporting all of our efforts within marketing initiatives, which may also include supporting advisors in their marketing initiatives as they provide educational information around alternative investments to their clientele. And if you want, I can tell you a little bit about Crystal too.
That'd be great. I'd love that.
Basically, we've been, as I had said right at the outset, we've been doing this for about 25 years, going back to the early 90s, early investors in alternative strategies specific to hedge funds, private equity, and private credit, and have been investing in many of the funds that you see today that are institutional and well-established because they've been going through so many different market cycles, have continued to grow their businesses. And today, Crystal really operates a very robust platform of investments, specifically focused on alternatives, that really provides advisors the keys that they need to support the institutional investment needs of their clients. So helping advisors and their clients gain exposure to institutional investment opportunities that are alternative, but simultaneously really navigating that path. And we'll talk more about that, but the world of alternatives has become pretty mainstream today. So whenever advisors can have guides, that's really the role that we play to help them from soup to nuts, supporting them with their alternative investment needs.
Perfect. Thank you. So I saw recently that Crystal Capital, the Crystal part of the name, was about transparency. And I think it's really neat because obviously in finance, that's something we want to gear ourselves towards. And in that is a lot of honesty. I think in really for me in working with clients that I have invested with you, there really is this clear transparency, in keeping with the name, and clients, I feel, really understand what they're getting in these investments. And it's something with alternative investments that is said to be a bit of considered downside is lack of transparency, but I think it's great that you and the firm really make a strong effort to make everything clear and as transparent as possible. So I thought maybe just could you go through alternative investments in simple terms? What are the kinds of categories of alternative investments out there?
Well, I appreciate you saying, as the name suggests, Crystal is really based on transparency. One of the unfortunate misconceptions of the asset class, in general terms, is that has been very little access to information, and that's really not the case. We really want to provide advisors, and for the benefit of their clients, with a transparent process, end to end. Understand what it is clients are investing into, the strategies that are there. We'll talk about that in a moment. The types of managers, and really have qualitative and quantitative information to help support decision making. We conduct a lot of that manager due diligence. We have third-party groups that also support us, that are independent of the process, to do operational due diligence as well. And really everything is in a very conflict-free manner, right? So what we try to do at the end of the day is really get a genuine understanding of what institutional managers are. To us, an institutional manager is really a firm that's been through multiple market cycles, is managing large pools of capital, where the management team there are typically the largest investors into their own program, which is really the case here at Crystal. We eat our own cooking, and we want to invest with managers that, in that regard, that really have a direct alignment of interest with investors, with their investor base. When you talk about alternative investments, let's really be simple in terms of the connotation of it, right? You're talking about strategies that are really supplemental to the traditional equity and bond portfolio, because hedge funds are also buying equities, and they may be doing it in a format that's similar to the way clients buy equity investments or invest in equities. But at the end of the day, you're talking about strategies that can help support, like a balanced diet, right? We all need to, we love certain foods. Maybe certain foods need to be balanced out with others so that we can continue to eat that. So no one is here saying you shouldn't use what you've been and it shouldn't be part of your diet. But certainly if you want to enhance the diet and have a better all around, better is the wrong word for your diet. But in terms of investing, if what you're looking at is having a well-rounded and the potential for having more attractive risk-adjusted returns, smoother volatility through time, alternative investments have really become commonplace. There are some, less traditional or less conventional alternatives that have sort of made their way into the conversation. Without question, art and crypto, digital currencies are becoming, part of that equation. But the traditional alternatives, as we refer to them, core alternative investment strategies, really refer to hedge funds, private credit, private equity, real estate, infrastructure, which in today's world can be both traditional as well as technological, right? When you're talking about infrastructure that this country needs as we move forward in many different realms, in addition to natural resources, would also be considered part of core alternative investments, if you will.
Excellent. Well, thank you for that explanation, and I'm sure the audience appreciates the clarification there. So I'm going to combine two thoughts. First of all, that alternative really isn't alternative anymore, and that perhaps alternative is the wrong name because it is taking such an important place in portfolios. And you all recently did an insights report on an article entitled The New 60/40 Portfolio. And I'm wondering if you could explain a bit about what was found in that article and what is the new 60/40 portfolio, and maybe compare and contrast with the old 60/40 portfolio.
Absolutely. So we author here at Crystal, for the benefit of educational content, twice a week, routine insights. And one of our recent insights discussed the ongoing efficiency, if you will, of the 60/40 portfolio. But let's first, just kind of break this down. And again, going with a simple assessment, the 60/40 portfolio is traditionally 60% stocks and 40% to bonds or fixed income. And that is a core strategy that is time tested and has been utilized in the advisory community, as you well know, Lisa, for a long, long time. However, as we pointed out, there are a number of macroeconomic factors or external factors in general that are impacting the current efficiency of the 60/40. And we really believe that there is a way with current trends and current environments, and which may continue into the future, that can only enhance the risk-adjusted personality of this portfolio by including alternative investments. So ultimately, in prior periods where you're talking about low inflation and low to medium economic growth, which is what we're faced with today, right? It's the topic of conversation between so many advisors and their clients. These factors in the past were actually conducive to the success of a traditional 60/40. But in today's sort of global regime change that we've seen macroeconomically, investors are really getting hit with a 1-2 punch. So looking at things in real life, right? What are we dealing with? On the equity side, you really have macro factors that are affecting both growth. So growth is slowing down. You have interest rates, which are ticking up globally to slow that growth down naturally, but that's having a real impact on company valuations and again, on the ability for companies to grow. So that's on your equity side. On the bond side of the equation, that 40% traditionally, right? You've got bondholders who are looking at a same dynamic with interest rates going up, with growth slowing down. And what that really means is the inflation that we're all seeing, in addition with the price of interest, the increase of interest rates, which ultimately leads to bond prices going down, is potentially leading investors toward having negative real returns in their fixed income portfolios. Again, if inflation is at 8% and your fixed income is only at 4%, there's an issue that needs to be made up for there. And so that's where we think, as you see the traditional 60/40 today having its worst performance since the global financial crisis of 2008, and in some cases, or it's at least on pace to do that, because in most cases, through where we're at this point in time, coming into Q3, 60/40 portfolios are down around 10-12%. So it's important for these investors to begin to start to help get an understanding and be able to potentially, with their advisors, adopt alternative strategies into their portfolios. Again, it's part of your diet, the nutritional meal, to start to incorporate things that can help mitigate the inefficiencies you may have in your diet. And we see the same analogy for an investor's portfolio.
Definitely understand. I had a conversation with a bond company yesterday, that does ladders of bond investments, and it's just really hard to have that discussion, as I told them, with clients when the rate of inflation is so high and the return on these bond ladder portfolios comparatively isn't keeping pace. And then you also have to consider tax that's going to, if you liquidate, what your tax will be on that in terms of your absolute return. And then, of course, in the case of my business, any kind of advisor fees on top of that, or firm fees. And so when you look at it and you look at the pace of inflation, it really is an important thing that's on investors' mind, which for me in allocating investments becomes really important as an advisor to be able to produce some kind of positive return net for my clients, which these days seems to be getting harder and harder to do. I wonder if you could speak to how alternative investments can be a hedge to inflation and some of the themes that we're going through at a macro level right now.
Absolutely. Going back to also part of the question you said about, how is the evolution of alternatives really supporting clients and the types of strategies? Alternatives, as we've been identifying here, and I think giving it some context in the overall industry of investing, alternatives are really pretty mainstream at this point. We will continue to see the industry, according to a lot of industry data that's out there. The industry will continue to compound very attractively at around 9.8%, not in terms of its return, but in terms of its appetite. And so what is today around an $8 trillion industry over the next 3 years is expected to reach around 17-18 trillion. So the opportunity set is robust. There is opportunity for investors to be able to gain exposure to this type of asset class. And again, it's a matter of what are the appropriate strategies that clients feel that they with their advisor that they can have investment to, right? Preqin has recently said that 81% of their investors, which are institutional investors, are looking to expand their access to the asset class. So you're saying our alternative investments are a hedge to inflation. we would look at what some of the smartest allocators out there are really doing to validate that point. When you look at combining alternative strategies when they are uncorrelated to each other, but again, that implies that you have to have the tools and the ability to get that quantitative information. And so with advisors we work with, that's a very large emphasis that the Crystal platform has the systems available to help that advisor make informed decisions. And so when you're combining these uncorrelated alternative strategies with what have historically been, the 60-40 or publicly traded equity and bond portfolios, you see that these strategies, the alternative strategies coupled with those, has historically yielded a substantial mitigation to risk, which ultimately makes these portfolios potentially compound at a more attractive rate of return, but also give them a better risk-adjusted personality and really further reduce their volatility and enhance potentially their rate of return relative to major benchmarks. Alternative investments, unfortunately, have been relegated to only institutional investors for so long. But in this fintech era that we live, we talked about infrastructure, that's software, and the fintech software elements are becoming much more and more prevalent in the industry. And having access to that has really helped to, for lack of a better word, democratize this part of the asset space and the asset class for both advisors and their investors.
Absolutely. What do you think about going forward when you say democratizing this space that has previously only been available at an institutional level? What do you think in the future we might see with that? Do you see someday that there'll be more opportunities? And I guess part and parcel of this question, I wonder if you could also sort of explain these unique qualifications that investors need to have in order to participate in alternative investment at various levels, the QP, the AI, if you could go into depth about that. And then I guess part of my question is in democratizing, we've already seen this progress where your firm is able to offer investments at lower minimums than institutions traditionally had to put into these type of investments. So if you could first go through the unique parameters about what kind of net worth you need to have in order to participate in these investments, and then also maybe do you see that changing in time, and then any unique structural elements that investors should know about alternative investments that vary from equities and bonds that they might be more comfortable with?
It's a great question as well, Lisa, I think, and also pointing out those elements. Part of the inaccessibility to alternative investments, on the one hand, is the qualification standard. The SEC has said that you must be a qualified purchaser, which in simple terms is an individual or a business that holds a portfolio or a family-held business or a trust that holds an investment portfolio of 5 million in assets or greater. When you're looking at qualifying an institutional QP, that is an entity that has 20, so you're talking about a foundation, an endowment, or other institutions that have to have at least 25 million or more to qualify as a QP. So then there is the accredited investor designation. When you're talking about, an individual, that refers to a person who has $1 million or more. In all these classifications, there are property-related exclusions. So it's important when investors are talking to their advisor that they understand how they can qualify themselves. An accredited investor who's filing a joint tax return is someone whose individual income exceeds 200,000 or filing jointly would be 300,000. So that is one part of what has created a barrier to entry into the asset class. Secondarily are all of the operational aspects that really investors should not be worrying themselves with, but has made it so difficult for advisors to bring these types of strategies to their clientele. What do I mean by the operational elements? Well, every client has to sign a subscription document. The minimums can be anywhere from 1 to 15 million in size. So it is the large institutional allocators who have historically been able to take advantage of these opportunities. But as we said before, technological infrastructure, the fintech community really maturing, platforms such as Crystal, there are now many opportunities for investors, both accredited and qualified, to be able to access the world of alternatives. Beyond the initial investment, there are so many operational elements from a reporting standpoint, from a management standpoint, and all of these complexities really need to be streamlined. And that's really where Crystal is trying to help advisors like Lion's Eye, so that clients can understand the fee structure, so that clients can get simplicity in capital calls. When you're talking about private equity, an investor commits to a manager that is making investments, identifying targets for investment, and an investor will receive capital calls. They should happen quarterly or can happen quarterly, but they may happen at different times. So the organization of all of this, streamlining it, consolidating it, things that Crystal is able to do, really has helped make the asset class so much more accessible, and it will continue to be so. And that's really the sort of the trend that we're seeing, that investors are able to access these funds, advisors, and these strategies. Advisors are able to bring them to clients, manage them efficiently, report on them, and then ultimately client portfolios can be the beneficiary, if you will, in the long term of experiencing exposure to these types of investments, be they private equity, be they hedge funds, be they private credit, be they real estate, cryptocurrency, art, wine, et cetera, so many other categories as we laid out at the outset of alternative investments.
It's so interesting that you say that. So not all of you in the audience might know, but the way I work as an advisor is that I use a custodial platform. And in my case, I use Charles Schwab as my custodial platform for Lion's Eye Wealth. And what that means is that the assets are held there, the equities, the bonds are held there. I give the advice, I do the investing strategy, but they're actually held there. And to that point, I think with Crystal, one thing that's been amazing is that we can report through Charles Schwab. So what that means is that if Charles Schwab doesn't have an alternative investment that might be the right fit for my client, I can go to Alan and team at Crystal, or other organizations that have alternative investments and really give a unique and specialty boutique exposure. I talked with the alts desk this week at Schwab, and they even said, we love alts and that, but even on a compliance side, which is technically a legal side, they're limited in what they can offer. Yet really encourage us as advisors to go out and seek the right alternative investments for our clients. And they've even said to me this week that if there was something I liked that felt strongly about that wasn't currently on the platform, to reach out to them and try to get it custodied at Schwab. So I think on the reporting basis, it really is neat how you're able to streamline that effort. And for me personally, with my clients, Alan and team is great, because if something capital call comes out and for some reason, this happened recently, a wire doesn't go through, they're right there letting me know. And on top of it, which is just amazing, I love the level of service that you and your team offer, the reminders, the insights, all of it, and really helping to streamline reporting and the transparency that your name even reminds us of with Crystal. So there's one thing that you sent over to me also that I thought was super interesting at an institutional level, was these Ivy League schools and their endowments that have upwards of 60% in alternative investments. And I wonder if you could just speak to that point to give more of like a real life example of how institutional investors are using alts and what that might mean for the more everyday investor.
That's a great point, Lisa. I thank you for the kind words. We appreciate the opportunity to support you again. And obviously, what we're continuing to see, and you alluded to a couple of interesting pain points that most people, unless they experience them, they're not really aware that it's there. Part of the challenge in alternatives, and we started to mention it, is that institutions don't have opportunity costs in the same way that high net worth investors working with their advisors typically do. Just the size of their portfolios. Institutional allocators who are very large have continuously had success. The endowments, the foundations, Ivy League or not, whether it's been large universities and major conferences, you see them. The ones that are having success playing football on Saturdays are also having success in the investment boardroom simply because of their ongoing exposure to alternative investments, which in many cases is in excess of 50 or 60% of their overall portfolio. Granted, the high net worth client who's sitting with their advisor may have very different objectives, but why shouldn't that investor be able to benefit from the same type of exposure, right? Other things that we're seeing right now, industry experts continue to monitor the data of asset allocation and flows data. And we have seen over the last 3 to 5 years a steady decrease in exposure to long only, right? That is long equities, what the market does, as well as fixed income. Mutual funds are experiencing a withdrawal of capital, and where we're seeing these institutional allocators go, and we, as investors with our advisors, we tend to be sort of the trend followers. As we see these institutions being able to continue to allocate, now that is happening more readily for investors, again, as the opportunities become more available. But those increases for investors away from the traditional side are now going to places like private equity and venture capital, followed by some of the more risk mitigating strategies in hedge funds, the income generating strategies in real estate, in infrastructure, and obviously in private credit. So where we think things move forward potentially as these strategies go is the additional impact to help clients build portfolios. By coming to alternatives and with an advisor, and this is where the evolution of alternatives and alternative platforms come in, is to support advisors who now can bring portfolio concepts to their clients. Client owns A, B, and C in this part of the portfolio, and be able to design portfolios of alternatives that can talk to those elements, complement those elements. And again, you need to have the analytical tools. Crystal as a platform supports our advisors in doing so that they have the tools to really understand, how can I make a portfolio more efficient? I see that university endowments, large US and non-US institutions are allocating to this space. It's to the benefit of their portfolio. By the way, you've seen the returns, it's public information, but throughout the last 3 years, portfolio returns for institutions in many cases are in excess of 30, 40, and 50%. And that's largely, again, because they are maintaining a 50 to 60% allocation to alternatives, but doing it within a portfolio so that you can have, again, organization. And going back to what you were talking about, the reporting, the scalability of investments, the capital calls, and the need for clients to have that transparency. That is not okay for a client not to be able to understand with their advisor what is their investment portfolio in these distinct classes of investment. What is it doing?
Great. Well, I think anybody would love to see that kind of return, especially with inflation the way it is currently. And certainly in my practice as an advisor, I allocate to alternatives because I believe in them. And just to your points that you've alluded to today, is there anything else you can think of that we haven't covered that's important for the investor to know about alternative investments?
Well, I think touching on what you were mentioning, yes, the returns sound eye-popping, but again, this is about being able to bring parts of the asset class, alternatives. Again, going back, we're talking about not completely alternative strategies. These are supplemental strategies to fixed income to equities. In many cases, hedge funds are buying traditional equities, but they're doing it in a format that mitigates the risk of the market because they can be directional in both ways. When you're talking about private equity, their ability to buy private companies, so the potential for growth of those companies as opposed to companies that are already in the public domain. On the private credit side, because clients are seeing trouble with their fixed income as a result of higher inflation, the ability for managers to identify, again, private companies and be able to underwrite loans that, again, can all be things that supplement the inefficiencies of clients' current portfolios, but also complement existing investments. That is the goal. This is part of making an overall efficient portfolio by having the ability to access these types of strategies. Not that there's a magic bullet, and not because they should completely overwhelm everything else that investors are doing, but have access to education, work with your advisors that can give you access to platforms in the fintech space, like a potential Crystal, that really gives knowledge. because the educational component, the knowledge becomes powerful, and then clients can really make informed decisions and map their journey through time. Because investing in alternatives, we've talked about liquidity, we've talked about capital calls, we've talked about the organization of portfolios. To understand all of those elements, to have that information at your fingertips, and then make informed decisions along the way. That's really the goal, and that's what we're trying to continue to do to empower advisors like you with what we've created here at Crystal.
Thank you, Alan. I have to say, you make it easy for me and also for my clients, and really appreciate how streamlined and effective the process is. And you make it really easy for me to go have these conversations with my clients and give supporting data, research, whatever they need to make an informed decision. And have to say that, loved meeting your team in Florida, and can definitely see the passion that you'll have towards the business that drives you towards it every day. And it comes through, and you work with me and the clients. And I think also the products that you offer for investments, really, it's been an amazing experience for me. And I have mentioned in previous podcasts that I'm real careful about who I hitch my wagon to, and vetting is something that I take very seriously. And I really love working with you and your team for that reason. And I'm probably not the easiest to just go along with anything. And so I really mean that as a compliment. And I think it's reflected in all of your work. So thank you so much for joining me today, and for the team at Crystal for supporting, allowing Alan to come on and talk with us and do this video and podcast today. I also wanted to let you all know that if you have any questions about this podcast and video, that you can go to the bio, go to my website, and you'll see my email, phone number, and also form where you can just get in touch with me if you have any questions about the content we covered today. So with that, I think we'll sign off, and thank you, Alan, so much for being with me here today.
Lisa, thank you so much for having us. It's really a pleasure to join you, and continued success and good luck to you and your clients.
Okay, thank you so much. Take care.
Bye-bye. You got it.